Most people sitting at 55 or 60 feel good about their 401k. They should. They did everything right. They contributed every year, maxed out when they could, let the balance grow. That part is real. But here's what nobody is telling them. The same account that built their wealth is quietly being reshaped by rules they never agreed to. And if they're still running on autopilot, they may be walking straight into a tax situation they did not plan for. I've watched this happen more times than I can count. Smart, disciplined people, people who saved more than almost anyone they know, end up blindsided, not because they saved too little, but because nobody told them when to stop, or how the rules just changed. This video is not about scaring you, and I'm not telling you to shut down your 401k tomorrow. But it is time to talk about where the math on this account actually stops working in your favor, especially with what the IRS quietly activated this year, in 2026. Let's start with the one part of a 401k that is genuinely mathematically unbeatable. If your employer offers a match, say they put in 50 cents for every dollar you contribute, up to 6% of your salary. That is an instant 50% return on your money before the market does anything. If they match dollar for dollar, that's 100%. The S&P 500 has averaged somewhere between 7% and 10% a year over the long run. There is no legal, low-risk investment on earth that hands you a 50% or 100% return on day one. I'll be honest about something. I don't claim to know every corner of Wall Street, but I've never seen anything come close to that. Not once. So rule number one is simple. Contribute at least enough to capture every dollar of your employer match. Every dollar you leave on the table there is just a pay cut you gave yourself. That's not opinion. That's arithmetic. Now, what happens beyond that point? What about the dollars you contribute above and beyond the match? This is where most financial advice stops. And this is exactly where the conversation needs to start. Every dollar you put into a traditional 401k above your match level is money you're locking away under a specific set of rules. Rules about when you can access it, how much you'll owe when you do, and who gets to decide those terms. Right now, in the year you contribute, those dollars lower your taxable income. That feels like a win, but that win comes with a price tag that's printed in invisible ink. Think about what tax deferred actually means. It means the IRS agreed to wait. It does not mean they forgot. Every dollar sitting in that account will be taxed when it comes out, at whatever rate applies to you at that time, not the rate that applied when you put it in. For a lot of people who saved consistently for 30 years, that balance is significant, which means the mandatory withdrawals that kick in later, the required minimum distributions, will be significant too. And significant withdrawals mean significant taxable income, whether you need the money or not. The habit of maxing out your 401k year after year feels responsible. It is responsible up to a point. But past the employer match, every extra dollar is also a dollar you've handed over to a system with its own timeline, its own tax rate, and its own rule book. That's the floor most people are building on without realizing it. Capturing your full employer match, non-negotiable, but blindly contributing beyond that, out of habit, without understanding what you're trading away in liquidity and tax control over the next decade. That's a different calculation entirely. There's a version of retirement that sounds like this. You worked hard, you saved well, and now you're done. The account is large. You feel secure. And you've been told, maybe by an advisor, maybe just by conventional wisdom, that when you retire, your income will drop, so your taxes will drop with it. For a lot of people, that assumption is completely wrong. Imagine someone who just turned 65. He spent his career doing everything by the book. He's sitting on $1,500,000 in a traditional 401k. He's proud of it, and he should be. He's planning to live on roughly 4% to 6% withdrawals a year, which is the standard guidance. That's $60,000 to $90,000 coming out of the account annually. Now add Social Security. A typical benefit at full retirement age runs around $35,000 a year. Do the math. $90,000 plus $35,000 puts his combined income somewhere above $120,000. That doesn't land in the 12% tax bracket he was counting on. That lands in the 22% to 24% bracket, higher than what he paid during most of his working years. And that's before Medicare enters the picture. There's a threshold called the IRMAA cliff. It stands for Income-Related Monthly Adjustment Amount. What it means in plain language is this. Once your income crosses certain levels, Medicare starts charging you more for Part B and Part D coverage. We're not talking about a small adjustment. For some people in that income range, it's an extra $2,000 to $4,000 or more per year, in premiums alone, on top of the higher tax bill. He saved $1,500,000. He followed the rules. And the reward is a tax bracket he didn't expect and a Medicare surcharge nobody mentioned at the planning meeting. Morningstar and Vanguard have both looked at this pattern. Their research points in the same direction. High savers who put everything into traditional accounts often end up paying more in taxes over their lifetime than people who diversified across account types. Not because they did something wrong. Because the math at scale works differently than the math at the beginning. The issue isn't the balance. The issue is that a large traditional 401k creates mandatory taxable income, whether you want it or not, whether you need it or not. Once required minimum distributions begin at age 73. The account forces your hand. Every year the RMD amount grows as the balance grows. Every year the tax bill follows it up. If you've been a disciplined saver, this is the trade-off you've been quietly making. Now, maybe you're thinking, fine, I'll just switch to Roth contributions going forward. That way at least the growth is tax-free. Reasonable instinct. But the rules just changed, and if you're over 50 and earning above a certain threshold, the government already made that decision for you. If this is the kind of analysis your advisor usually skips over, that's exactly why this channel exists. Hit subscribe. We stay close to the actual numbers, not the comfortable version of them. So you're thinking about Roth. Smart instinct. Put money in after taxes, let it grow tax-free, pull it out in retirement without owing anything. No RMDs, no forced withdrawals, no Medicare surcharge surprises. It sounds like the clean solution, and for a long time it was a real option you could choose. I have to be straight with you about something. A few years ago, I was still telling people over 50 to lean into traditional catch-up contributions. Max them out, take the deduction now, manage the tax bill later. That was the standard playbook, and it made sense in the context it was built for. That playbook is gone. The Secure 2.0 Act, Section 603, is no longer coming. It is here, active, and applied to your paycheck right now in 2026. And what it says is this. If you are 50 or older and your prior year wages exceeded $145,000, you no longer get to choose between traditional and Roth for your catch-up contributions. The IRS made that choice for you. Every catch-up dollar must go in as Roth, meaning after tax, no deduction, tax before it ever hits the account. Let that sit for a second. The financial content you're consuming, the YouTube videos, the podcast episodes, the advisor brochures, most of it was written before this rule took effect, or it's being recycled from sources that haven't caught up yet. You'll still find people debating traditional versus Roth as if it's an open question for high earners over 50. For a significant portion of that audience, it is not an open question anymore. The door closed. Here's what that looks like in real numbers. The catch-up contribution limit for ages 50 through 59 in 2026 is $8,000. If you're between 60 and 63, there's a newer provision called the Super Catch-Up, and that limit rises to $11,250. These are the amounts above the standard annual contribution that people in this age range can add to their 401k each year. The extra deposits designed specifically to help late-stage workers accelerate their savings. Under the old rules, that entire amount could go in pre-tax. You'd get the deduction today and defer the tax bill to retirement. Under the current rules, if your income clears $145,000, every dollar of that catch-up goes in after taxes. No deduction. The IRS collects now. For someone in the 22% bracket, contributing the full super catch-up of $11,250 means roughly $2,475 in additional federal tax this year alone, just on the catch-up portion that they weren't paying before. Multiply that over several years of catch-up contributions, and the gap between what people planned for and what they're actually paying is real money. The people being blindsided right now aren't careless. They're the ones who set up automatic contributions years ago and haven't revisited the settings. Their payroll deduction is still running. But the tax treatment underneath it changed, and nobody sent them a notice that reads clearly enough to understand. This is not a loophole closing. This is a structural shift in who controls your contribution strategy, and right now, for high earners over 50, the answer is the IRS. Knowing this doesn't fix everything, but not knowing it is expensive. Here's a situation that plays out more often than most people realize. Someone turns 55. Maybe they took an early retirement package. Maybe they just decided they were done. Either way, they leave their job with a 401k sitting at their former employer, let's say around $1 million. And the first call they make is to a brokerage to roll that money into an IRA. It feels like the right move. IRA accounts often have lower fees than employer 401k plans. Brightscope data shows that fees at smaller company plans can quietly eat 1% to 1.5% of your balance every single year. On a $1 million account, that's $10,000 to $15,000 gone annually before the market does anything. Rolling into an IRA to escape that drag is not a dumb instinct. It is, in many ways, the financially literate thing to do. So he signs the paperwork. The money moves. He feels like he just took back control. 3 months later, the furnace dies, the roof needs work, and he needs $40,000. He goes into the IRA to pull it out. The 10% early withdrawal penalty hits immediately. That's $4,000 straight to the IRS, on top of ordinary income tax. He's not yet 59 and a half, so there's no exception to hide behind. What he didn't know, and what almost nobody told him before he signed, is that there's a provision called the Rule of 55. It allows people who leave their employer in the calendar year they turn 55 or later to take penalty-free withdrawals directly from that employer's 401k. No 10% hit. Full access, with only ordinary income tax owed. But the Rule of 55 only works if the money stays in the 401k. The moment it moves to an IRA, that protection is gone permanently. You cannot move it back. The rollover is irreversible, and the exception does not transfer. This is the trap. The action that looks like smart financial management. Reducing fees, simplifying accounts, gaining more investment options is the exact action that eliminates a meaningful legal protection you may need in the years between 55 and 59 and a half. And the window matters. That 4 to 5 year stretch before penalty-free IRA withdrawals kick in at 59 and a half is precisely when early retirees are most likely to need liquidity. A medical expense, a home repair, a family situation. Life does not pause because your timeline says it should. The fee argument is real. The rule of 55 protection is also real. Most people are only told about one of them before they make the decision. If you're in this window, or approaching it, the question worth asking before any rollover is simple. Do I have enough liquid assets outside this account to cover 4 to 5 years of unexpected costs? If the answer is yes, rolling over might make sense. If the answer is no, or even maybe, the 401k may be worth keeping exactly where it is, fees and all. Flexibility has a dollar value. So does a penalty you didn't have to pay. So let's say you've done the thinking. You've captured your employer match. You understand the tax exposure sitting inside a large traditional account. You've decided to redirect some of your savings toward more flexible accounts, a taxable brokerage, a high-yield savings account, something you can actually reach without a penalty or a mandatory timeline. That's the right instinct. Building what some people call a liquidity bridge outside your retirement accounts is genuinely good financial practice for this stage of life. But there's a problem waiting on the other side of that decision, and it has nothing to do with the IRS. It has to do with your bank's software. Here's what happens. Someone, let's say he's 62, decides to move $12,000 from his local savings account into a brokerage account he just opened. Straightforward transaction. Legal money, legally earned, legally saved. He logs into his banking app to initiate the transfer and hits a wall. The app caps digital transfers at $3,000 per day. So he does what any reasonable person would do. He splits it up. $3,000 on Monday, $3,000 on Tuesday, $3,000 on Wednesday, $3,000 on Thursday. On day 4, his account is frozen. No warning, no phone call in advance. Just locked, pending review by the fraud department. What triggered it wasn't the amount. It was the pattern. There's a federal rule most people have heard of. The $10,000 reporting threshold. Banks are required to file a currency transaction report for cash transactions above $10,000. But that rule applies specifically to physical cash. It does not apply to digital transfers between your own accounts. What people don't know is that banks run a separate layer of monitoring entirely. Suspicious activity reports, or SARs, governed by anti-money laundering regulations. And the behavior that flags those algorithms isn't about the dollar amount. It's about the pattern. Structuring transactions to stay under a reporting threshold. Even if you've never heard of that threshold, even if you're doing it for completely innocent reasons, is exactly the behavior those systems are trained to catch. The algorithm doesn't know you're moving your own retirement savings. It sees a pattern that matches a known evasion technique, and it acts accordingly. I've been close to situations like this. The worst part isn't the frozen account. The worst part is what comes after. Sitting on hold for 45 minutes with the fraud department, then getting questioned like you have something to hide, when all you were trying to do was move your own legally earned money from one account to another. That feeling is hard to describe if you haven't been through it. It's humiliating in a way that has nothing to do with guilt. The fix is simple, but you have to know to ask for it. Instead of initiating the transfer through your banking app, call your bank directly and request a wire transfer. A wire is processed as a single, documented, authorized transaction. It does not trigger structuring flags. It does not look like evasion. Banks process large wire transfers every day. They are routine on the institutional side, even when they feel large on the personal side. One phone call replaces 4 days of app transfers and eliminates the risk entirely. The broader point here is this: the financial system runs on patterns. It was not designed with a 62-year-old moving retirement savings in mind. It was designed to catch bad actors, and the filters are blunt instruments. Knowing how those instruments work and how to move through the system cleanly is part of managing money at this stage of life that nobody puts in the brochure. None of what we covered today is meant to make you feel like you've been doing it wrong. You haven't. The 401k is a genuinely powerful tool. Tax-deferred growth, employer match, automatic contributions. For the accumulation phase of a working life, it is hard to beat. The people who used it consistently for 20 or 30 years made a smart decision. That part holds. What changes is the context. At 55, at 60, at 65, the questions shift. It's no longer just about how much goes in. It's about what comes out, when, at what tax rate, and under whose terms. So here's where the framework lands. First, always capture your full employer match. Every dollar of it. That 50% or 100% instant return is real, and it is irreplaceable. Nothing else in a legal investment account competes with it. Second, understand what's sitting above that match. A large traditional 401k is not just an asset, it's a future tax obligation. RMDs will force withdrawals whether you need the income or not. Combined with Social Security, that income can push you into a higher bracket than you planned for, and across the IRMAA threshold that inflates your Medicare premiums. That's not a reason to panic. It's a reason to plan across multiple account types. Third, if you're over 50 and earning above $145,000, the Secure 2.0 Act already decided your catch-up contribution strategy for you this year. Your catch-up dollars are going in as Roth, whether you chose that or not. Know what's happening in your own paycheck. Fourth, if you're near 55 and considering a rollover out of your employer's 401k, stop before you sign. The rule of 55 is a real protection, and it disappears the moment that money moves to an IRA. Make sure you have enough liquidity elsewhere before you give that up. And fifth, when you start building the liquidity bridge outside your retirement accounts, which is the right move, use wire transfers for large transactions. Don't split them across multiple days on a banking app. The anti-money laundering algorithms are not subtle, and being flagged is a headache that's entirely avoidable with one phone call. These aren't radical ideas. They're adjustments. Small course corrections that compound into very different outcomes over the next 10 to 15 years. The financial system runs on autopilot settings that were designed for a different phase of your life. Contribution rates, account structures, transfer habits, most of it gets set once and left alone. That made sense at 35. At 60, those same defaults can quietly work against you. This channel exists because that gap between the generic advice and the actual mechanics of how this works at your age and income level is where most of the real money gets lost. Not in dramatic crashes, not in obvious mistakes. In the details nobody thinks to mention until it's too late to adjust. If that's the kind of conversation you want more of, subscribe. We'll keep going.